Imagine paying more for a single flower bulb than you would for a luxurious mansion in one of Europe's richest cities. This isn't a fairy tale. It happened in 17th century Holland. At the height of the frenzy, one specific tulip, the prize Semper Augustus, was exchanged for a package worth 12,000 Dutch guilders, a sum greater than the value of a high-end townhouse in Amsterdam. How could a tiny bulb, a fragile bit of horticulture, become the most expensive commodity on earth? And why does this single event, the so-called Tulip Mania of 1637, continue to haunt every modern conversation about irrational markets, from Bitcoin to the latest tech stocks? The popular narrative paints Tulip Mania as a catastrophic national event where common bakers and chimney sweeps mortgage their lives for flowers, only to see the entire Dutch economy crash overnight. But what if that story is mostly a myth? This is the deeper, more complex story of the world's first recorded financial bubble, a tale of exotic beauty, viral speculation, and a crucial twist that divides economic history from cultural legend. We will uncover the true mechanics of the trade, the stunning reason why the bubble burst, and what its lasting legacy, both real and manufactured, reveals about the psychology governing your investments today. The seed of rarity, origins, and exoticism. To understand a mania, we must first appreciate the tulip itself. When tulips first arrived in Western Europe via the spice trading routes in the 16th century, they were unlike anything native to the continent. Their vibrant colors and exotic origin lent them an immediate sense of luxury and exclusivity. But it was a specific type of tulip that ignited the speculative fever. The broken tulips. These bulbs, infected by a non-lethal virus, displayed stunning, feathery patterns. Crimson flames running through white petals, as seen in the legendary Semper Augustus. Because no one understood the underlying biology, they did not know how to reliably reproduce or break a tulip. These stunning variations were incredibly rare, lending them immense value. Scarcity was the ultimate driver. By the 1630s, tulip ownership was a sign of prestige, initially confined to a relatively small group of affluent merchants and artisans in the Dutch Golden Age. As demand rapidly grew, the price wasn't just driven by wealth. It was driven by the fear of missing out, or what speculators today call FOMO. The rise, trading in the Windhandel. The crucial shift from horticulture to high finance occurred between 1636 and 1637. Because the tulip bulbs needed to be stored underground and were only available for actual delivery during the summer, the speculative market transformed. Trading shifted entirely to futures contracts. Traders bought and sold pieces of paper, promises guaranteeing the right to specific bulbs that would bloom the following spring. This futures market was known in Dutch as Windhandel, wind trading, aptly named because they were trading nothing but hot air and future hopes. This abstraction of the asset from the physical item was revolutionary. It meant anyone could enter the market by buying options or futures, regardless of whether they could actually afford the bulb. Prices reached a fever pitch in the winter of 1636. At its peak, a single contract for a Semper Augustus was worth enough to pay a skilled craftsman for years, and fortunes were being made and lost in the very same day. The speculation was pure group psychology, an irrational exuberance where the only reason to buy a bulb was the belief that a greater fool would pay more for it tomorrow. This collective delusion created a textbook asset bubble. The breaking point, February 1637. The bubble burst in February 1637. The breaking point was not a grand piece of legislation or a bank failure, but simply the moment a critical mass of buyers realized that the prices had completely decoupled from reality. Perhaps a few major speculators decided to cash out, or maybe a shipment of bulbs failed to deliver. Whatever the specific trigger, the sudden lack of new buyers, the greater fools, caused panic. Since the market was based entirely on futures contracts, confidence was everything. When confidence vanished, the market collapsed overnight. The paper contracts guaranteeing the right to the bulbs became worthless. Panic selling ensued, and those who had borrowed money or leveraged their fortunes to enter the Windhandel were financially ruined. The price of the most sought-after bulbs plummeted, quickly reverting back to a fraction of their peak value. The fallout, separating myth from reality. The collapse was dramatic for those involved. But here is the essential modern twist that challenges the popular legend. While the price crash was real, the effect on the wider Dutch economy was minimal. Recent academic scholarship argues that the tulip trade was primarily confined to a relatively small group of wealthy merchants and artisans who were playing a high-stakes, localized game. Many were simply trading paper promises amongst themselves. The widespread belief that the mania led to a national economic crisis, crippling the entire Golden Age economy, is considered largely a myth. The true, lasting consequence of Tulip Mania was cultural and moral. The event was immediately seized upon by writers and preachers who used it as a parable against reckless gambling, greed, and immorality. The story became a cautionary tale, designed to shame those who participated in the speculative frenzy. This moralizing narrative, rather than macroeconomic disaster, cemented Tulip Mania's legacy as the quintessential bubble, a dramatic, easy-to-digest lesson in human folly. Modern parallels, the cycle repeats. The power of Tulip Mania as a cautionary tale lies in how perfectly it models every speculative frenzy that followed. The underlying dynamics remain a constant feature of financial markets. Consider the dot-com bubble of the late 1990s. Like the tulips, the internet was a fundamentally valuable, exotic, new technology. But investor psychology, the belief in a new economy and the fear of missing out FOMO, drove valuations for companies with zero earnings to unsustainable heights. When the NASDAQ Composite Index peaked in 2000, it eventually fell 78%, wiping out trillions of dollars in wealth. Even more recently, the NFT non-fungible token craze drew direct comparisons to the 17th century flower. Both involve highly speculative prices for a product with little clear utility, driven by a viral event and group psychology. In both cases, the real value lay not in the physical or digital asset itself, but in the collective belief in its future rarity and desirability. The chase of the bubble, ignoring basic financial analysis, is always the core problem. Conclusion: the enduring warning. Tulip Mania, whether national crisis or localized folly, offers three clear, timeless lessons for navigating financial markets. The danger of abstraction. When an asset is traded primarily through futures, options, or digital contracts, the Windhandel, it creates a dangerous gap between the price and the intrinsic value. This abstraction allows prices to detach completely from reality, making the market highly fragile. Psychology is a sovereign. Financial stability is ultimately a matter of collective confidence. Once that confidence breaks, legal measures or underlying scarcity cannot prevent a crash. The collapse is driven by a psychological switch from greed to fear. Myth is more powerful than reality. The most important lesson of Tulip Mania is that the narrative surrounding a collapse often becomes more potent than the actual economic damage. This narrative shapes future regulation and investment behavior, teaching us that understanding financial history is as much about debunking the myth as studying the data. The cycle of irrational exuberance is not a historical aberration. It is a repeating pattern driven by human nature. The warning of the tulips is simple. Whenever the price of an asset relies solely on the assumption that a greater fool will pay more tomorrow, you are no longer investing. You are betting. Which seemingly stable asset today, digital or physical, is actually relying on Windhandel to maintain its price. If this journey into the secrets of the world's first bubble resonated with you, hit the like button and subscribe for more deep dives into financial history. Share your thoughts below. What modern asset do you think will be remembered as the 21st century Semper Augustus?